Fed cuts rates as expected. The Reserve Bank of Australia looks set to hold next month after strong inflation figures, and the Bank of Japan and the European Central Bank will make rates decisions tonight. That's coming up in our 5 Things in 5 Minutes on Thursday, October the 30th. And then in our deep dive interview, ANZ Commodities Strategist Soni Kumari analyses how metals markets may react to today's summit between Presidents Trump and Xi.
If they do end up striking a deal, we'll probably see precious metals like gold and silver take a bit of hit, while industrial metal could see a lift purely from sentiment perspective.
But first, in 5 and 5 with ANZ, the US Federal Reserve has just cut its key federal funds rate by 25 basis points to a range of 3.75% to 4%, as expected, citing a slowing jobs market. It also announced that from December the 1st, it will end its program of Quantitative Tightening, or QT, which is the selling of bonds from its stockpile built up during COVID, by QE, or Quantitative Easing, which is bond buying. Its stockpile is still worth well over $6 trillion US. However, it's down by $2 trillion since QT started in 2022. As of just after the Fed decision at 5:15 a.m. Sydney Melbourne time, the S&P 500 was up 0.2%, holding on to its gains from before the decision, and the Nasdaq was up 0.5%. The yield on the US 10-year Treasury rose 2 basis points after the decision to 4.022%. The yield on the 2-year Treasury rose 3 basis points to 3.52%. West Texas oil futures were up 0.7% at $60.59 US a barrel. Gold was up 0.4% to $4,000 an ounce US. The US dollar index up 0.2%, the Aussie dollar up 0.2% as well to 66.01 US cents, and the Kiwi was flat at 57.84 US cents. Number 2, the Reserve Bank of Australia is set to keep rates firmly on hold at next month's meeting after quarterly trimmed mean inflation of 1% beat expectations in the third quarter. Here's ANZ senior economist Adelaide Timbrell.
Compared to our forecast, which was 0.9% with upside risk, there was a little bit of upside, which was the 1% trimmed mean measure. That came from more health inflation than we expected. We actually expected health prices to come down a little bit and they were stable. A little bit more housing costs than we expected. So that came from very strong property rates and charges, fees, increasing things like council fees. It was also from some more gas and other household fuel inflation than expected. Of course, electricity was up a lot as well at 9% in the quarter, but we did expect it to be around there.
Number 3, the annual headline rate rose to 3.2%, above the Reserve Bank of Australia's 2 to 3% target band. However, Adelaide says it's set to ease back in coming quarters.
The headline inflation figure going above 3% is not likely to be as much of a worry for the Reserve Bank as it usually would be. And that's because it is being influenced by the roll-offs of government rebates for electricity, which means that we have seen electricity on an annual basis rise by 23.6%. But that is after, of course, a huge dip in electricity prices. This is why the Reserve Bank cares about the trimmed mean measure a lot more than it cares about the headline inflation number.
Number 4. Global market attention now turns to 2 key central bank meetings today. First is the Bank of Japan. ANZ international economist Tom Kenny expects rates to stay on hold, but with 2 dissenting votes wanting a hike. Tom says the election of a dovish new Prime Minister shouldn't affect the call.
Governor Rader has been very cautious in recent times, and particularly about the outlook of domestic politics and trade policy uncertainty. Although there's been some resolution on the domestic policy side, there's still, I think, a few unknowns there. And on the trade policy side, uncertainty there remains elevated. I think that's enough for the majority of the Bank of Japan board members to feel a bit cautious going forward.
Number 5. The European Central Bank also has a rates decision overnight. ANZ economist Bunzi Madhavani expects the ECB to hold rates but maintain an easing bias.
Our view is that the officials will reiterate that policy is in a good place and maintain that policy settings will be data dependent and determined meeting by meeting. Look, the ECB have noted that the rate cutting cycle is broadly concluded, although we maintain an easing bias and expect 125 basis point cut at the December meeting. That's mainly because growth recovery is still fragile. Fiscal policy driven support to growth is yet to materialize and household consumption growth is weak.
Bunzi Madhavani there. Now, in our deep dive interview, ANZ Commodities Strategist Soni Kumari analyses how today's meeting between US President Donald Trump and China's President Xi Jinping could affect markets for precious and industrial metals. She's speaking here to my colleague Alex Tarrant.
The US-China trade tensions have significantly affected both precious and industrial metal markets this year, but the impact has diverged. Industrial metals are considered growth commodities, while precious metals are favored during times of uncertainty. So when trade tension escalate between the US and China, gold becomes a go-to safe haven. And this was evident during March and April when gold prices reached a record high during the peak of the trade tension escalation between the US and China. And recently, renewed trade tension accelerated the rise in gold prices towards 4,400 before retreating as tension appeared to ease after the US and China announced to have a trade deal framework. And for industrial metals, the story is bit different. Trade tension tend to put a downward pressure on economic activity and usually means less demand for industrial metals like copper and aluminum. But here there is an interesting bit. Whenever there is even a hint of deal or progress between the US and China, industrial metals are getting a fresh boost, especially because there are supply constraints elsewhere, like we have seen in the recent incident of series of supply disruption affecting major copper mines.
And so then how important is this meeting between Presidents Trump and Xi? How important is this meeting for the metals markets?
This meeting is important for metals market as the US and China relationship is one of the most important bilateral relationship in the world and could potentially affect the direction of global trade flows. But the impact, as I mentioned, will diverge for both precious and industrial metals. So while market is already pricing a tentative trade deal, the confirmation of deal could clear a layer of uncertainty. Yet the relationship between these two countries will not be fully restored.
So which metals are most likely at risk, I guess positively or negatively, from the outcomes of these talks?
Well, it really comes down to what happens at the meeting. If they do end up striking a deal, we'll probably see precious metals like gold and silver take a bit of hit, while industrial metal could see a lift purely from sentiment perspective. But if there is no deal and it's likely to go to the other way, precious metals might rally, and at the same time, the industrial metals could suffer. There will be a short-term, diverging move in both that. Let's take an example of copper and gold, but gradually market will take guidance from idiosyncratic fundamental factors. Like for copper, supply constraint will be the dominating factor, while demand at the same time looking a bit softer. China's growth for the last quarter also looks weak, and economic activity, especially in China, have started showing some cracks. So therefore, we expect copper prices may peak in the short term despite a trade deal, especially in absence of any further supply deterioration.
And you mentioned that roller coaster that the gold price has been on recently. It has been dropping in recent days. Is this mainly profit-taking or different risk attitudes, or is this a new fundamental shift in the gold price?
So it seems easing tension between the US and China gave a reason for investors to book profit. And as a result, prices have, come off sharply below 4,000 range. Further price correction is possible depending on the, trade deal outcomes. And we see, latest price correction could bring prices in the range of 3,500. Having said that, we believe the factors supporting gold prices are still far from exhaustion. Therefore, we continue to see gold as a risk diversifier and a strategic asset in investors' portfolio. So every correction in gold prices is expected to bring fresh investment demand as well as some consumer demand, pushing prices higher. We are expecting prices can go or peak towards 4,800 by mid-2026.
Soni Kumari there talking with Alex Tarrant. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, October the 30th. Catch you tomorrow with reaction to the G3 central bank decisions today and tonight. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.